US stocks have eased away from all-time highs. European markets are still some distance from record levels, and the US dollar is hovering above its 3.5-year low. We're heading into the summer months, typically a quieter time for the markets. But is that the case this time around? And what should we be watching? To talk me through this and more, I'm joined by Global Head of Retail Dealing, Alex Ridges. Thank you for joining me, Alex.
Hi, Fiona.
Hi there. So what is the market outlook now that we're entering the summertime?
Well, we're entering earnings season. Again, always a fascinating time. And as I said in my last talk, we sort of know AI stocks are doing fine. So this earnings season was what's the outlook? We're really looking to see some outperformance in non-AI stocks. I think it's next Tuesday, we've got some healthcare. We've got Johnson & Johnson and United Health, and also banking sector. So we've got Morgan Stanley and Goldman's. And then I think then we're on to Netflix the same week, and then Tesla the week after. So really, so why I'm saying this again as the key sort of outlook is since the lows of April, we've seen the Mag 7, the Magnificent 7 stocks rise 36% from the lows. But actually, the rest of the S&P has only rallied 24%. So I'm sort of, that gap is starting to open up.
And is this gap a worry?
Well, yes, I think it really is. I mean, we could say, well, actually, why is AI outperformance a worry? But I was looking at some stats this morning, and if you when we're looking at the gains in the S&P 500, it's almost like how many, as we're sort of talking about general periods where we've seen record highs, which we're in at the moment, despite a little bit of a downturn. How many of those 500 stocks are actually rallying versus falling? And typically, when we're hitting highs, we're seeing most stocks rally. And now we're actually seeing a bit of a dichotomy where it's only sort of 88 to the positive. So we've got sort of 294 rallying, but actually 206 falling. And again, you say, well, why is this a worry? Going back to sort of stats from 1972, every time we've seen a period of breaking new highs, and there's been less than that sort of 88 swing positive to negative. Anytime we've seen that less than 100, the next 12 months have been underperformance.
So is this the start of a bubble?
Well, yeah, I mean, very good question. And the way I'd almost sort of, when we're thinking about bubbles and what causes a bubble, essentially at the moment, if you're an investor, you're thinking, well, the only thing going up is AI, so therefore I better invest in that. And of course, that fulfills itself. More investors pile in, and all of a sudden, we've got tech stocks and AI stocks completely overvalued, and there's a massive panic sell-off and a crash. And at the moment, I think when we're looking at what's driving the S&P between 2010 and 2024, it was sort of 22% of the stocks were considered the main driver by a few measures. But at the moment, we're at 10%. So it's almost a no and a yes. We're not in a bubble yet. But again, if we see that exacerbation of good AI results and poor performance elsewhere, we could well see that.
And so what's the ideal scenario for earnings season?
Well, it's a strange one because, of course, everyone wants good results, and good results everywhere. Everyone's happy. But what we've seen recently is actually, or since January anyway, is a real drop in expectations. So I think at the turn of the year, expectations were for sort of 12% income growth, certainly amongst the S&P 500 companies, and that's dropped to 4%. So in a way, I think I talk about it a little bit, this grind higher we're seeing. The last earnings season, we saw outperformance by 7.5% against expectations, which, on the whole as an investor, you'd be like, great, I'll be really happy with. But actually, on those announcements, we saw an average, from 7.5% average beat, as it were, that only caused 0.1% average move up from all the stocks. So in a way, good results are sort of already tangled into expectations for this sort of slow or gradual move higher that in this phase we've hit. On the negative side, that's where we're going to see big drops from any underperformance. So in reality, as you say, what do we really want to happen? Massive overperformance probably isn't going to happen, and if it does, just that bit of caution to investors about expecting overperformance. I think we're just ready. We're happy with a slow grind higher, or that seems what investors are happy with.
And tariffs. We have to talk about tariffs. So are we going to start seeing tariffs showing up in negative or having a negative impact on earnings?
Well, I mean, I think to some extent that's possibly why I talk about this sort of slower move higher. That's been caused by tariffs rather than, it's all right, we're not falling, but rather than significant gains we could have been seeing with a lot of the headwinds disappearing. It's very much a case of investors saying, well, we're going to move higher, but we're still going to be cautious. We're not going crazy here. I mean, like Samsung results came out overnight and they announced, I think, a 56% drop in quarterly profits, which is significant. And they basically put the blame on write-downs from tariffs, I think, because they're limited how they can import into China now. So that's what we're seeing from tariffs. We are seeing the negative impacts. But in some sense, some, I suppose, positivity, Samsung didn't actually drop. Their share price stayed the same. So that leans, while there is negativity from the tariffs, largely everything is still positive.
So generally positive. Anything negative to balance this out?
Yes. What's keeping me up at night is not the companies themselves, but actually the governments behind them. We've seen recently that investors are demanding higher yields from bonds. Essentially what they're saying is we don't like government policy. We don't like the way the US and the UK in particular are going. It's very much a case of overspending and inability to cut costs, and so of course an increase in debt. So my worry is this sort of vigilante investing is almost coming back. We saw it with Liz Truss. Essentially, it brought her premiership sort of down, as it were. And I just worry that, again, if we see this happening where as bond yields continue to rise, there's a real panic, and all of a sudden crashes in the bond markets leach through to equities. So while we're largely positive, that's the sort of the scenario I see for things unraveling.
Excellent. Well, thank you very much for your analysis once again, Alex. For more videos like this, please do like and subscribe.